We've had a massive reversal on Friday. AVGO was down 8%, Micron 13%, Meta is down 5.5%, Nvidia is down 6%, Amazon is down 3%. It was a bloodbath out there. The QQQ was down like 4 or 4.5%. It was a large one-day drop. We're already hitting fear territory, guys. I mean, not even a one-day drop. We're trading at fear territories. People are fearful. People are got a little bit spooked by the magnitude of the sell-off in general. And I don't know why people are getting spooked. Like, you guys should know the playbook by now. We have one or two declines, same thing, about an average of 14% pretty much every single year. People panic, you get fearful, you feel bad that your portfolio is going down. But whenever you feel is that it's hard to buy. Normally, it's the best time to be buying. You act against your feelings and you buy the dip and you make money once the market goes up. I mean, that's how it's been pretty much since 2000. And it's happening again. So I don't know why people are so upset whenever we have such declines. We should welcome such declines to buy our favorite stocks at a discount. Now, in terms of the overall decline, it's not even a blip on the chart, guys. I mean, we're barely just took off the gains that we put up over the last few weeks. But I told you guys before, I'm expecting a sell-off into the Fed meeting, and I still believe the sell-off will likely get worse, and I'm going to tell you why in today's video. Now, the reason why we sold off on Friday was due to the job report being much better than expected. Good news is bad news in this market, because if the job report isn't too bad, and you have the CPI sitting at 3.8%, with the target being 2%, that means the Fed will likely be hiking interest rates without worrying about the job market. And this is exactly what the market is starting to price in. They're pricing in a 64% chance of a rate hike. Inflation is very, very hot, especially the month-over-month increase. Over the last 2 months, it has increased at a pace not seen prior to 2023. So it's been ramping up rapidly. If we look at the components of the CPI, most of the increase came from energy, was about 17.5% increase within the CPI. Other components have increased about 2% to 3%, still above the 2% target, but all in all, it was mostly energy that has contributed to the massive increase in the CPI. Now, energy prices or crude oil has been coming down from about $108 a barrel, now sitting at $90 a barrel. If you look at the futures curve, oil is expected to keep coming down and expected to go down up to $79 a barrel by December of 2026 and up to $75 by mid-2027. So oil prices are not expected to remain elevated forever, but the market is still pricing in a rate hike. Okay, and the market is rarely wrong about those things. But if I had to bet, I would bet on Kevin Walsh not hiking interest rates, which is why I'm expecting a sell-off into the Fed meeting and a massive recovery after that. And if you look at Kevin Walsh and his mentality, it's a very different mentality from Jerome Powell. Now, the market is pricing in a rate hike based on a Jerome Powell playbook. But I think the Kevin Walsh playbook is entirely different. We're going to find out more during the meeting. But he said a lot of things during his Senate testimony that will give us an insight into his playbook and into how he views things, which is very different from what Jerome Powell views things pretty much since 2016. So this is an entirely new paradigm. And I'm going to read some of those things to you, and they're very, very important. Now, one of the things he is known for is he wants less reliance on headline inflation numbers. This is a big one. So we're reading the CPI, we're saying that we could have a rate hike because of CPI, but he doesn't care as much about the CPI. He's expressed skepticism that mainstream measures like the CPI and the PCE, they pretty much don't capture the right inflation rate. He prefers something called trim mean inflation, which includes the highest and the lowest inflation data point, and he's floated the idea of new inflation measures like a new survey of 1 billion prices to capture a more comprehensive view of price changes. He's also voiced the concern that the Fed places too much weight on these indexes, effectively allowing backward-looking data to dictate policy. In this view, because the CPI and PCE reflect what has already occurred, and because the Fed policy inherently long with work lags, the Fed is pretty much always behind. So instead, Walsh has suggested the Fed should place greater emphasis on judgments and on forward looking economic analysis, evaluating where longer term forces such as productivity gains and technological changes like AI, which is deflationary, may put the economy versus, pretty much focusing on the past. So if you look at the CPI right now, most of it is driven by a one off event. What is the one off event? The war in Iran. That's what's driving oil prices. Oil prices are coming down. Once the war ends, it's expected to go down. You're likely going to have supply from Iran. You're likely going to have supply from Venezuela. And you have massive supply from the United States coming up, especially on the natural gas, ramping up productivity like never before. So that's not a permanent problem. That's more of a temporary problem. So if Kevin Walsh is not wanting to look backward, he wants to look forward, he's unlikely to be hiking interest rate on something that's actually transitory or something that's actually temporary, while he discussed many times that AI is a deflationary force or disinflationary force and it leads to productivity gain. So if I was to analyze the statements that he said, I would say he's unlikely to be hiking interest rates, And I think that's why Trump chose him, because he's going to focus more on longer term stuff and on future looking stuff, which he may not pay attention too much to the CPI and PCE because they're being pumped up due to one-off events, which is the energy problem, and it's a temporary problem because of the war in Iran. And I believe once that ends, energy prices should plummet in a major way. So as the market is pricing in a rate hike, stocks are going down. I see a setup where we don't have the rate hike, but the market sells off into the meeting in anticipation of something crazy happening, but then nothing crazy happens, and I think the market recovers, and we potentially make new all-time high. So that's how I'm personally viewing it. Now, some people said that that's unlikely to happen because on Friday, I believe this Friday, next Friday, we have the SpaceX IPO, and you can't crash in an IPO. Maybe. I mean, I've seen this before. That kind of makes some sense. But there's a few things you have to take into consideration. The first one is that the market is forward-looking right now, and it's more forward-looking than ever before. And if you look at Rocket Lab, ASTS Space Mobile, they're up 20, 30, 46% over the last months alone. Not because they're great companies, but in anticipation of the SpaceX IPO. So a lot of those stocks are going up in anticipation of the IPO. Once the IPO comes up, are they going to go even higher? But they already went up in anticipation of it. So the market is pricing those things in. So could we go down in a SpaceX IPO? I would say yes. I'm not expecting a massive crash, but could we just go down if SpaceX IPOs? I would say of course, because the market was pricing those things in before the IPO actually happens. Now, something else to take into consideration is the S&P index is not going to make a special case for SpaceX to be fast-tracked right into the index. It's going to have to wait about a year for them to be included in the index. And that's really good, because if it was fast-tracked into the index would have been forced to sell other companies like Amazon, Meta, and Nvidia for them to include SpaceX. But that's not going to happen. So there's not going to be as much of selling pressure as we've seen before, which is great for the overall market, But if you look at the trend in general, we always pretty much have a decline into the Fed meeting a little bit after the meeting. Tom Lee says that the market tests a new Fed share, and this is true. The average decline with the Fed share is about 12%. The median is 8%, and we never had a positive, you could say. I mean, we did have positives, but I should say during those 3 months, we tend to have negative, drawdowns, 3%, 4%, 5%. And I would not be surprised if we see the same thing. Now you have the VIX going up. It was like 16, sitting at 21. We still have runways on the VIX, So I'm seeing a setup where we could go down a little bit more into the Fed meeting. Kevin Walsh doesn't hike interest rates, and the market recovers. That's what I'm personally saying. I'm not seeing the start of a massive stock market crash just because SpaceX is IPOing and Anthropic and OpenAI. Now, those things, they mark euphoric tops because you have a lot of euphoria. But it doesn't mean that when OpenAI goes public, this is the exact top to the tick or to the day, and then we go down. Normally, those things bring optimism, and we go higher and higher and higher after them. After a few months, then the market tops and we go down. And that's what happened in 2021. That's what happened in 2000. And so I'm not really seeing anything crazy now. Just you could say, a small correction and a rally after potentially the Fed meeting. And then we could, if we want to have a massive drawdown, it will likely happen in 2027 when you don't have the midterm elections and you don't have all these things, But if you look at the valuations, they're really not bad at all. I mean, we're trading at 21 times forward earnings. That's not really expensive. Now, if you look at the PEG ratio is actually below 1. So the growth relative to the earnings is pretty much below 1. So the market is really, really cheap on a price to earnings growth basis because the earnings numbers have been getting revised much, much higher, mainly due to Micron and SK Hynix and a lot of the semiconductors. They're putting up massive, massive numbers, and that's helping earnings growth in general, which is why the PEG is below 1, which is indicating that the market is undervalued if those companies deliver on their growth number. And to sum it up, I'm again not seeing anything crazy. You have the president, he's watching the market every single day, especially going into the midterm. He wants lower oil prices and he wants his stock market to be higher. And anyone that was betting against the president so far has lost money. On Intel, you say Dell Computers in April, even now in March, April, he posts tweets and then the market recovers. So they want the market higher, at least into the midterms. And I personally wouldn't really bet on it. So I'm seeing, you could say, a pullback, maybe a short pullback, 5, 6, 7, 8%, and potentially a rally after the Fed meeting. I think the OpenAI, or I should say the SpaceX IPO, doesn't really mark a top and then we go down after and then all these things. I think it could happen, but I think it's unlikely to happen this year. If there was a time for that, I think it will come in 2027. So for me personally, I couldn't be more excited about this pullback. I have my list of stocks ready to potentially buy into a next bull market leader, and I don't think it's going to be in semiconductors. I'm personally seeing other opportunities in nuclear and other things, and I share everything I do in my group, by the way. This is the link if you're interested. But thank you very much for watching. It was not financial advice. I hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.